Getting divorced in Minnesota and have divorce mortgage questions. Going through a divorce can be all consuming and trying to get clear answers can be difficult. That's my goal in this video is to lay out clear answers to some of your key questions. I'm going to go through removing your name from a mortgage in Minnesota in the process of divorce. Then we're going to talk about buying out the house in the course of a divorce. We're going to talk about how child support and separate maintenance impacts your ability to get pre-approved for financing in the future. Finally, we're going to talk about some specific tips that you really want to pay attention to with regards to your credit while you're going through a divorce. Hi, I'm Peter Lindquist with the Lindquist team at Guaranteed Rate in Woodbury, Minnesota. I've been originating home loans in Minnesota for over 30 years, and I've helped dozens of couples through the process of divorce as it relates to their mortgage. If you like this video, please like it below, comment, share, and consider subscribing to my channel if you would. Let's start with, can you remove your name from a mortgage while going through the divorce without having to go through a refinance? And I will say that it's very rare. It can happen on a loan that if your current loan is FHA or VA, both of those loan types have assumable features, which means that whoever's going to be on the mortgage can file paperwork with the loan servicer to assume the mortgage into just their own name. They have to qualify for that, and you would talk to your current mortgage servicer if that's eligible. That's not eligible on the most common type of loan, which are called conventional conforming loans. If you have one of those, you're going to need to refinance. Do you need to get your name removed off of the mortgage? Well, technically, you don't need to. However, it is highly recommended that you do so. If you're the person that is leaving the house, the big reason why you want your name off the mortgage is actually regarding your credit report. Just because your divorce decree says that you are no longer responsible to make those mortgage payments, the loan servicer never agreed to that. They report to the credit bureau just as though you are living in the house. So if your ex-spouse makes a mistake and has a late payment on the mortgage, it can trash your credit just as though you were living in the house. I have a specific scenario, a borrower who went through a divorce in this situation, hadn't talked to the ex-wife in years, and it turns out that about 2 years ago, his ex-spouse went through a foreclosure, and so his credit was trashed for years to come. And obviously, we want to try to avoid that. So I would highly recommend requiring a refinance out of the person's name who's no longer going to be in the house. Okay, let's talk about how to buy out your ex-spouse from the property. So there's two ways. The first one is really uncommon. I'll just mention it. If the person who wants to remain in the house is not entitled to the property currently, they can actually buy it from their spouse. In that situation, we would get it all pre-approved and ready to go. And as soon as the judges signed off on it, you would close on the purchase of that house from your ex-spouse. But that only works if you are not entitled to the property. So assuming that you are, then it's a refinance. So to buy out an ex-spouse with a refinance, we use provisions from various loan products, conventional, FHA, VA, all have guidelines where you can add whatever it is that it takes in order to buy out your ex-spouse to the new mortgage, and then that's a refinance. Importantly, it's called a rate and term refinance when we do that. Why is that important? It's because it is a much lower interest rate than the alternative, which is called a cash out refinance. If your mortgage lender is not experienced in this field, they may be offering you a cash out refinance. Those interest rates can be as much as 1% higher than the alternative, which is called a rate and term refinance. So I'll give you an example. Let's say that your house is worth $400,000 and you owe $300,000. So you've got $100,000 of equity. If you and your ex-spouse agree that you're going to split that equity evenly, that means that you need to come up with $50,000 in order to buy out your ex-spouse. So the new loan amount would be 350,000. Home value is 400,000. New loan amount would be 350,000. That's possible to do, and it's possible to do as a rate and term refinance, which is less expensive than a cash out refinance. If you go to a lender who views it as a cash out refinance, number one, interest rate's going to be much higher. And number two, the maximum loan amount that they'll go to would be 320,000. They'll go to 80% of the appraised value of your current home. So clearly, you don't want to end up doing it that way. Now, people will often ask about valuing their homes, and I point them back to their attorney or their mediator to discuss what method you're going to use for evaluating the value of your home. I've seen a number of different ways that people choose to do that. They might use the appraisal that we do in the course of a refinance. They might each independently get their own appraisal. That actually is very common. And then they argue about the value until they come up with the value. I've seen more kind of flippant decisions where they just said, well, let's use what we find on an online calculator. That would be a bad decision. Whatever method you have decided with regards to coming up with a value on your house, then we need to look at that and you'll tell me how much you need in order to buy out your ex-spouse, and then we'll proceed with a refinance. I do want to note one important thing, and that is that with regards to the mortgage, there's only one appraisal that matters to us. That's the appraisal that we did. So if you and your ex-spouse each come up with an appraiser and you each independently appraise the house. Let's say one of you appraises it for 390 and the other one appraises it to 410. That's fine as far as you're concerned, and you've agreed on the value being 400,000. When it comes to getting a mortgage, your mortgage balance is going to be really impacted by what our appraised value is. And each appraiser can look at it differently. Each appraiser may be looking at it at a different period of time. So if you both get your appraisals in March, but then you're refinancing in October of that year, now a whole new set of values have come in because different homes have sold in the neighborhood, and your value could actually be lower than what you guys agreed on. So, for example, you have agreed that the value of the home is 400,000, but in October, the appraiser comes back and says that the home is valued at 360,000. Our new loan amount is based off of that 360,000. And in that specific case, you've agreed to pay your ex-spouse 50,000. And now we have to do a $350,000 mortgage on your house in order to accomplish the buyout. The problem is our appraised value is 360 at that time. You wouldn't even have enough resulting from that refinance in order to do the buyout. So, yes, you can come up with values with your own appraisers, but I just want to be very clear. There's only one value that matters when it comes to refinancing a mortgage, and that's whatever your lender does. Now, a big part of that is that our appraisals are done by independent contractors. And there are laws surrounding that so that we know it's an independent appraisal if we have ordered it. Because as a loan officer, I have no contact with that appraiser. The appraiser is picked from a round robin of potential appraisers. So whoever is going out to the property is really doing this from an independent standpoint. In a divorce, one spouse wants a certain value, the other spouse wants another value, and oftentimes those appraisals come in to match whatever the spouses want them to be. Well, as a mortgage lender, we don't care about those. We care about the real value, and that's how the valuations work with regards to your mortgage after a divorce. Let's talk about child support and alimony and how that impacts your ability to qualify for a loan. So we'll start with if you owe that. If you owe child support or separate maintenance, alimony, that amount is considered a monthly debt, And so when we are calculating your debt to income ratios, we have to calculate that number. So if it's $1,000 a month, we would treat it the same as though you had a car payment of $1,000 a month when you are trying to qualify for a new loan. So that's how it impacts you that way. Now, with regards to counting child support or separate maintenance as income, that is your choice. Not everybody wants to count that as income, but if you want to use it for qualifying, some key points to understand. Number one is that you have to have received that income for a specific period of time, 3 months, 6 months, or 12 months, depending on the loan product that you're getting. The most liberal of those is called FHA. So if your divorce is done in January, you'll be approvable once you've received 3 payments. So those payments are February, March, and April. After your third payment is received, and they've all been on time and they've all been for the amount that is specified in the court decree, now we can count that income in your qualifying if that's what you want to do. Other types of loans require 6 months or 12 months. If you're depending on that income to qualify, you need to plan accordingly around that. The other key factor is that income has to continue for at least 3 years beyond closing. We always have to be cognizant of the age of the children in the course of qualifying you, because if any one of them is expected to turn 18 in less than 3 years after closing, now we've got a problem and you can't use that income to qualify. Occasionally, there'll be a child support order that says you got to help them all the way through college. So maybe they're 21 or 22 that child support will be received. That's okay if we're counting those 3 years. So you have to be able to demonstrate that you've received it, and you have to be able to demonstrate that it's going to continue for at least 3 years after closing. That's the way that we can count your child support. Now, I want to note something going forward into the future. Sometimes ex-spouses will come to side agreements about how much that child support should be after the divorce is all done, because it's less expensive than going through court. I would highly recommend that you go through court in order to establish what those new amounts will be. I've had situations where the borrower's child support was $1,500 a month, and some of the children had moved out. And so the two ex spouses had decided that it's only going to be $600 a month, but they never went to the court in order to adjust the court order. Well, that makes it very difficult to qualify for a new home loan if that $1,500 a month is standing in the way. So even though they agreed on $600 a month, I had to count $1,500 a month because it was never agreed to by the courts. The last thing that I want to talk with you about divorce mortgages in Minnesota is that it's really important to pay attention to your credit during this period of time. If you do not belong to a credit monitoring service, I highly recommend that you do so. Credit during a divorce can be problematic for many reasons. Number one is pretty basic, is that one person is moving out of the house. So a bill may come to the old house and that person never sees it. It goes late, and now that impacts credit. Or oftentimes there's just a lack of communication going through the divorce. So one person is expecting the other person to pay a bill and they don't. Well, and then that goes against you. So you're both impacted with credit, late payments. I just want to encourage you that even though it's a really hard period of time, I do highly encourage you to use a credit monitoring service so you are paying attention to what's happening with finances and any joint liabilities. Even if you have agreed that you're not going to pay them and the other person has, pay attention to those and watch them online. Make sure that those payments are getting made on time. Another thing to note is that if you have any joint debts, and that can be as simple as a joint credit card that is not closed as a result of the divorce, and the other person keeps it, while you and the ex-spouse might have agreed that you are no longer responsible for that debt, it still is being reported to your credit report. And so the balances and late payments and anything like that will impact your credit. if you have any joint credit after the divorce, you've got to monitor it every month until that's gone. I would again recommend that if you can eliminate any joint credit immediately upon divorce, you should end up trying to do that to avoid those kinds of problems. We've covered a lot of different scenarios with regards to divorce mortgages in Minnesota, and I would be honored to be the lender to help you out with any of these. Please make a comment below, or my contact information is in the description, and I would be glad to work through and try to help you with any of the questions that you have with regards to divorce mortgages in Minnesota. Thank you.